Your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion, delivered by conflicting media reports. We connect the dots, you know, the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We're a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference, 800-306-1990, 800-306-1990. And, of course, we are celebrating today. We celebrate every day on Ron Siegel Radio. And thank you to our nurses, National Nurses Day today. Okay, we appreciate our nurses. They do a great job. Let's see, National Crepe Suzette Day. I like crepe Suzettes. There's not a lot of places you go and get some of these things nowadays. Crepe Suzettes, I don't know. Who's got good crepe Suzettes? They're good to munch. And tying in today, today is also National Beverage Day. Now, I don't know. I'm looking at the pictures of National Beverage Day. Josh, you've had an interesting one there. I guess that's what you call a real top-down approach. So, National Beverage Day. The question is, are we talking adult beverages? Are we talking family, all-around beverages? What are we talking about here? And I guess you get to call any of them that you want. Okay, so remember today's National Beverage Day because we're going to get back to that in just a minute. Let's take a look and see what the markets. Josh, do you want to do the question of the day first? Okay, it fits right in. Question of the day. Being that it is National Beverage Day, do you prefer beer or wine? Beer or wine? Put that in the chat if you're watching us on Ron Siegel Radio TV, any of our socials while we're recording this in the morning. Would you put that in there for us? I see there's a bunch of folks online here. Beer or wine? What do you prefer, beer or wine? Okay, come on. You guys can do it. They're both, it's only 4 letters. We can put beer or wine. What do you prefer, beer or wine? Right in there. Okay, we're going to move right along while you're frantically typing away, I hope. Let's see what the markets are doing today. The Dow Jones Industrial Average is up 47 points. S&P 500 is up 29. The NASDAQ is up 112 points. Oil up 62 cents per barrel. And the 10-year Treasury down. It's at 4.499. Call it 4.5. Now, that was moving up quite a bit before. Let's take a look at gas prices. $5.35 a gallon here in the formerly Golden State. Ow! Yeah. Josh, you're at $4.50. So you're legitimately probably about $1 a gallon cheaper than we are here in the formerly Golden State. $3.65 is the national average. Now think about this, because I did watch some of the Sunday shows yesterday, or the weekend shows, and they're talking about some of the folks in California, some of the legislators, looking and seeing if there's price gouging going on with gasoline. They always seem to forget the one place that gouges us in California on gas prices. Yes, that would be the state of California with taxes and fees of, last I saw, about $1.10 a gallon, $1.12 a gallon, taxes and fees. Now, let's see. If we take $1.10 a gallon and add that to the $3.65 national average, comes to $4.75. $5.35 is the state of California. And, we've got to have everything done special for us. We're special in California. Ugh. I mean, yeah.
You know better than that.
So they're getting ready to change the blend of the gasoline. So, they change the blend, and that's when we know that we've got things that are more unique. So then they take certain refineries have to go offline for planned maintenance. And then you get into the effect of they call supply and demand. So if you are a gas delivery company and you can make a certain amount per load, would you rather go to deliver from the refinery, say in Carson, to Los Angeles or to Baker, California? Well, of course you'd rather go to Los Angeles. Number one, it's quicker. You can get in and out and get more loads done in a day. And it doesn't cost as much in your own transportation, your own fuel to go back and forth. Because remember, fuel trucks go round trip, but one way they're empty. Right? That's when you go and drop off. I watch them come over to the Costco station not far from where we're recording today. And I think they make 6 loads a day into that Costco. Well, every time they leave, they go back with nothing in the truck. So if you're going from Fullerton or Yorba Linda or Tustin back to a refinery, wherever that might be, or you're going from Baker back to the refinery, empty, think about that concept. So it's not a matter of price gouging, folks, Mr. Governor, other than the state of California gouging us because, we need to have this for the roads. Has anybody noticed how great our roads are out here? I travel on the 55 freeway frequently. Not the road you want to be on. Every lane has a pothole in it. Moving right along. I get off my soapbox. I don't know if this one's, I had never seen this before, and we'll have to talk to our friend Kristen Messerly when she comes back on because she does monitor and survey millennials and Gen Zs. Josh, you fit into this category. Let me know if you're seeing this amongst your peers. New report here. Amex is going heavily after the millennial and the Gen Z customers, and they found that they were giving millennials and Gen Zs free American Express cards, and they weren't really that excited about it. And now they've found out that the millennials and Gen Zs, surprise, surprise, American Express didn't realize this, that the millennials and the Gen Zs are smart individuals, and they're doing their homework and comparing the credit cards and seeing what kind of perks are being given by each of the different credit cards, points and miles and rebates and all that. And American Express has figured out that the millennials and the Gen Zs would rather pay $695 a year to get an American Express Platinum card and all the benefits that come with it versus getting a free American Express card. I don't know. Josh, are you seeing that? Okay, Josh is shaking his head yes in the background there. He's running the show as always. So American Express Platinum card, that's what they're seeing out there. So millennials and Gen Zs going American Express. Let's see what else we're seeing going on in the world right now. Here's another one. In-N-Out deciding they're not going to the East Coast anytime soon. Yes, it is a family-run business. They're going as far as Eastern Tennessee. Last year, In-N-Out announced its plans to open up further restaurants in Nashville, Tennessee, making its first expansion east of Texas for the California-based chain. Not expecting to move anywhere further, according to Lindsay Snyder, the owner and president of In-N-Out. They like to keep their stores within 500 miles of a company distribution center. 500. Well, I'll just throw this out there for you. 500 miles from a company distribution center. That's about how long it's going to take you to get in through the line at In-N-Out. I mean, their lines are crazy. Do you have In-N-Outs, Josh, in Vegas? Long lines? They're not as bad. Okay. So our lines here, they're crazy. I look at them. Doesn't matter what time of day I drive by the In-N-Out. Lines are always nuts. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, what's motivating your move? We'll talk about it. We're going to talk about 5 mistakes that might be hurting your FICO scores and simple ways to fix them. Auto and homeowners insurance basics that everyone needs to know and more. Reach me anytime off air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. Hey, don't forget, would you prefer beer or wine? Put it in the comments section. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. Man, did my forehead get big or what on this? Okay, Josh, this may not be such a good idea here. I just changed this a little bit. So, oh, well, we'll see what happens. Mortgage Minute brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. And every day at this time, OBMMI. They provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry. Calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. They don't tell us points paid, points received. They only tell us what the rates did, what the rates locked at. So what did they do on Friday? Latest data that's available. 30-year conforming loans, those were down quite a bit, 7.087. 30-year jumbo loans, those were down quite a bit, 7.217. 30-year FHA down 6.803. 30-year USDA down 6.80. That's the rural areas, generally no down payment. And the 30-year VA loan, best loan on the market for the veterans, only 6.51. That was down a quarter of a point, 6.516. If you want our market commentary, we put that out every morning as early as the data allows. We put out that market commentary. And yes, we already did send that out today. So the market commentary, rsrmarketminute.com, rsrmarketminute.com. Let's see what's going on in the markets this morning. That's what we look at all the time to see where we are after we get through, where we want to find out what's driving us today. And we look at the S&P 500. We see that is up 28 points right now. Okay, we'll watch that because you're going to be surprised with what I have to say today. 30-year mortgage, the mortgage-backed securities, those are up 4 basis points, which means interest rates on the mortgage-back down just a touch, not a lot. 10-year Treasury, that's flat, 4.50, flat on the market for the day, so no change right there. What's driving these markets? Well, today, not a whole lot. There's not a lot going on. We did get the ISM services report. U.S. economy has not had a broad-based recession just yet, but it appears there's been a rolling recession, meaning certain sectors have gone into recession like manufacturing. This has been evidenced in the regional manufacturing reports and the national ones like the ISM Manufacturing Index, which is in contraction, getting smaller, going down. Not good. Meanwhile, the services sector has appeared to be resilient. Last Friday, however, the ISM Services PMI for April fell from 51.4 to 49.4. entering contraction for the first time since December 2022. Looking at the internals, the employment component slid from 48.5 to a 4-month low of 45.9, coinciding with the weaker jobs report. Prices paid or inflation component was high at 59.2, but that has been trending lower. This number was 64 in January and 60 a year ago at this time. We also know that almost all of the inflation we're seeing is coming from the services sector. So this was somewhat expected. Bottom line, you don't listen to what they're telling you. There may be a recession coming. We might even already be in one. Active listings, Realtor.com released their active listing figures showing that they increased from 695,000 in March to 734,000 in April, which is an increase of 5.7% monthly, 30.4% from last year. Additionally, new listings rose 9.2% in April to 432,000, the largest increase since July 2022. If rates cooperate, the table appears to be set for more transactions. This is a lot of pent-up demand. We know that. The annualized pace of existing sales is only 4.1 million when the norm is typically a million more than that. Within the increase in inventory, and if rates continue to trend lower, possibly with help from the Fed, Treasury, and continued weaker jobs data, we could see things start to get better. And I know that sounds odd. Weaker jobs data means it gets better. Interesting. Camden Property Trust, which is a company that owns and rents roughly 60,000 rental properties in the U.S., reported that supply is flooding the market and that blended rates are only up 0.6% year over year for the month of April. That is a huge difference from the 5% rental increase we are seeing in the CPI and the PCE inflation reports. When these catch up, you're going to see that inflation numbers are better than what we've been talking about. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. So let's chat a little bit about something that we've done on Ron Siegel Radio for years and years and years. Actually, since we started doing this in 2010, telling you what the media, the big banks, what they don't want you to know about. And we get a lot of our data from many, many sources. We start scouring sources, all sides, and try and get as much politics out of it as we can. It's hard to do that, but we try our best. So understanding the economic indicators, and a lot of them are skewed. So here, what do I mean by skewed? So I talk a lot about the BS report that comes out from the Bureau of Labor Statistics. And that BS report, the Bureau of Labor Statistics report, is interesting in that they model. That's how they get their data. So that's when we see that we get the information the first Friday of the month, unless it's the first Friday of the month is the first of the month. Generally, they'll wait a little bit, but generally we get our data the first Friday of the month. Well, when we get that data, how do you think the Bureau of Labor Statistics gets that? It's all done by modeling. They look at the first-time unemployment rate reports. Whatever report is in the same week as the 12th of the month, that's where they get that. They do other kinds of modeling things in there. But then there's a report, and if they call you and they want to talk to you, you don't have to respond. If you don't respond, no big deal. Well, then there's another report that comes out, and that other report that comes out is something that they must respond to. The Bureau of Labor Statistics sends out to about 1.5 million businesses a report saying, what's your labor count? What's your head count? Well, if you listen to the BLS report that came out the first Friday of the month last year, they kept telling us, we're gaining jobs, gaining jobs, gaining jobs, gaining jobs. By the time we got into the third quarter, they're saying, we've gained 600,000 jobs, according to the survey report. Well, the real number was we actually lost jobs when they started doing the actual head counts from that 1.5 million businesses that they required to respond. 1.5 million jobs. I'm sorry, 1.5 million businesses now reporting that they've actually got a job loss. What's that do for the economy? What's that tell us about what's going on in the economy? Because we keep hearing about how great the economy is. Okay, so then we get the jobs report that came out on Friday, and we were planning, or the economists, the brain doctors, thought that we were going to have 240,000 new jobs, but there was only 175,000 created, less than the expected. Again, showing a slower jobs market. The unemployment rate ticked up slightly, 3.8 to 3.9. And while this seems small, even minor increases can signal broader economic shifts. Service sector. This sector includes everything from restaurants to banks, affecting many jobs. Slowing down. What does this mean for you? Slowing job market might mean it's a good time to reassess your budget and prepare for uncertainty. If you're job hunting, it might take longer to find something new, or if you're unemployed, it could be a time to focus on job security and skills enhancement. Now, there's a rule out there called the McKelvey rule. It's a tool and it tracks changes in unemployment, historically predicted recessions. The recent data supports its activation, suggesting that we might already be in a recession or heading towards one soon. Does it feel like a recession to you? Broader impacts? Well, there's been an acceleration in layoffs, indicating companies are feeling the economic pinch. Increases in bankruptcy filings are another sign of economic distress for businesses. Now, what is the solution? What do you do for all of this? Well, I'm going to suggest tighten your budget to prepare for potential financial instability. Increase your emergency fund. If possible, boost your emergency fund to cover unexpected expenses in tougher times. Consider enhancing your skills or learning new ones to maintain your employability. And from an economic standpoint, and I've shared this one with you many, many times, take a look at your household budget. That's a biggie. Now, if you were with us last Thursday, thank you. If you were not, shame on you. But you heard us talk to Todd Ballinger, and he was talking about the Home Select product from Geneva Financial. This, I submit to you, could be one of the biggest saviors anybody has when it comes to household finance. Why? Because you're putting the equity that you have in your house in a state where you can actually access it if you need to. Now, I do not recommend accessing it to go on a new trip to Maui, or to go buy a new car or a boat, or using that as an ATM. No, I'm saying that if you have an emergency, if you lose your job, if you have to take a pay cut, well, having that access and having it ready could be highly beneficial. And we're going to talk a lot more about that tomorrow. You can reach me anytime off air, number 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numero 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Hey there, friends. Wondering if now is the right time to buy a home? Or are you waiting for a bunch of foreclosures? The facts speak loud and clear. Defaults and foreclosures are down, sure. We might be headed towards a recession. But did you know interest rates typically drop and real estate values often go up during a recession? So what are you waiting for? Higher prices or higher payments? Don't navigate these waters alone. Connect with RonSiegelRadio.com today. That's RonSiegelRadio.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio. Or anytime at 800-306-1990, 800-306-1990. Wonder which light takes care of the shine on my head. Real-time real estate segment brought to you by rsrmoney.com. rsrmoney.com. Let's see what we've got today. The perks. We have that. The perks of buying over renting. I don't know if that's is Oh no, we did. What's motivating your move? That's what. What's motivating your move? Top 2 reasons. Okay. Think about selling your house as you make your decision. Consider what's pushing you to think about moving. A recent survey from Realtor.com looked at why people want to sell their homes this year. And we've got a graph if you're watching us on RonSiegelRadio.tv, our socials, or ABC News and Talk AM 1490 video feed. 24.4% to make a profit, 23.7% for family reasons. Let's take a closer look and see if they're motivating you to make a change too. Number 1, to make a profit. If you think about selling your house, you probably have a lot of questions on your mind. Well, here's some good news. The latest data shows most sellers get a real return on their investment when they sell. Adam, a property data provider, explains, quote, home sellers made a $121,000 profit on the typical sale in 2023, generating 56.5% return on investment, unquote. That is a national stat. Remember, in California, most of the time we double the numbers. That's significant, and here's one contributing factor. During the pandemic, home prices skyrocketed. There was way more buyer demand than homes available for sale, and that combination pushes prices up. Now, home prices are still rising, just not as fast. That ongoing appreciation is good news for your bottom line. Any profit you can make can help offset some of today's affordability challenges when you buy your next house. If you want to know how much your house is worth now and what's going on with prices in your area, chat with a local real estate agent or go to rsrmoney.com, rsrmoney.com. Number 2, for family reasons. Maybe you want to be near relatives to help take care of older family members who have more support nearby. Or maybe you're just eager to spend time together on special occasions like birthdays and holidays. Selling a house and moving closer to the people who matter the most to you helps keep you connected. If the distance is making you miss out on some big milestones, it might be time to talk to a local real estate agent to find a place close by. The National Association of Realtors, NAR, says, quote, a great real estate agent will guide you through the home search with an unbiased eye, helping you meet your buying objectives while staying within your budget, unquote. Bottom line, if you're thinking about selling your house, there's probably a good reason for it. Let's talk. Let's set up a strategy. And that's the Real-Time Real Estate segment brought to you by rsrmoney.com, rsrmoney.com. I will share with you that I should have told you about this in the last segment. But when you're looking for data specific to your area, your zip code, we do have a tool that we use. We give it away. And rsrlinks.com/market report, rsrlinks.com/market report. That is from our friends over at Altos Research. They track every home available for sale every day or every week. And they come out with this report every single Monday telling us about the properties. Now, when you go there, you're going to fill out a little bit of information, but make sure you put in the zip code you're most interested in. It may or may not tell you. It might pop up with just Anaheim or something. But don't worry about that. rsrlinks.com/market report, rsrlinks.com/market report, and you'll be able to get that report on a regular basis. It'll actually send it to you every week if you subscribe to it. It's your choice. One little message a week lets you just know what's going on in your world. That is the rsrlinks.com/market report. Let's go to Your Credit Matters segment brought to you by rsrdebtfree.com, rsrdebtfree.com. We talk about this one on a regular basis because we want you to understand on the rsrdebtfree.com. Right now, if we head into a recession, things tighten up. And as they get tighter, it becomes harder and harder to get loans. You might want to look into that right now before before these things hit the public eye. We're telling you about it, but they're not public yet. 5 mistakes that might be hurting your FICO scores and simple ways to fix them. Building good credit can benefit your life in many positive ways. A good FICO score could make it easier to qualify for financing products like loans and credit cards and to receive better borrowing terms when lenders approve applications. As you work to earn and maintain a good FICO score, it's important to learn about the mistakes you should avoid along the way. When you study common missteps that could damage your credit, it's easier to steer clear of these potential issues in the first place. Number one, late payments. Payment history has a significant influence on your credit, making up 35% of a FICO score. Therefore, when your credit report shows evidence of late payments, those negative items have the potential to cause credit damage. To make matters worse, late payments can remain on your credit reports for up to 7 years. On a positive note, the impact that late payments may have on your FICO scores tends to become less meaningful over time. Nonetheless, it's best to avoid these derogatory notations altogether if possible. The following tips could help you avoid late payments. Set up automatic payments with lenders and credit card companies. Schedule payment reminders on your smartphone and with your creditors if available. Don't forget rsrccpayment.com, rsrccpayment.com. We show you exactly how to do this. Number two, revolving a balance on credit cards. Credit cards can be useful financial tools for numerous reasons. A credit card has the potential to help you build credit when you manage the account in a responsible way. Plus, as a credit card holder, you can enjoy fraud protections and a convenient payment method, potential rewards, and other perks. But carrying a balance on your credit cards from 1 month to the next is a mistake that could cost you money and negatively impact your FICO scores. The ideal way to use a credit card is to pay off the full statement balance on your account by the due date each month. When you pay less than the amount and revolve a balance from 1 month to the next, you'll have to pay interest charge to your credit card company. You might also increase your credit utilization ratio when you revolve a balance on your credit cards. A high credit utilization ratio could also negatively impact your FICO scores even if you pay your bill on time every month. If you're struggling with credit card debt, it's important to try to find a solution to improve your situation. Depending on your situation, a debt payoff plan might be worth considering. Debt payoff plans like the debt snowball or debt avalanche have the potential to help you reduce your credit card balances little by little, saving you money and potentially improving your FICO scores along the way. Tip, if you can find extra money in your monthly budget, you might be able to speed up the process. Don't forget rsrccpayment.com. Not checking your credit. Forgetting to check your credit is another mistake that could come back to haunt you. It's important to review your 3 credit reports on a regular basis to confirm that the information is error-free and does not show any signs of fraud or identity theft. If you discover credit report errors, you have the right to dispute them with Equifax, TransUnion, and or Experian. In addition to keeping tabs on your credit reports, it's also wise to monitor your FICO scores. Changes in your FICO scores may alert you to potential credit problems when and if they arise. And if you're working to improve your credit, monitoring your FICO scores can help track your progress. Cleanall3.com, cleanall3.com. Great resource for tracking your credit with a real mortgage FICO score. Number 4, co-signing. When you co-sign for a friend or family member, it puts your personal credit at risk. As the co-signer on a loan or credit card, the lender will hold you equally liable for the debt. If the primary borrower or account holder stops making payments for any reason, you'll be obligated to step in and repay the credit obligation in question. Additionally, as a co-signer, the loan or credit card is likely to appear on your credit reports as well. If the account has any negative payment history associated with it, like late payments, default, collections, those derogatory items could impact your credit as well. Even if your friend or family member pays on time, being a co-signer might make it difficult for you to qualify for financing in your own name. Co-signing for a credit card, for example, could affect your credit utilization ratio. And any extra debt that shows up on your credit report could impact your debt-to-income ratio when you apply for future loans. If you want to help a loved one build credit, you might consider adding him or her as an authorized user to one of your existing cards instead. This approach could assist your friend or family member in their credit building goals. However, adding an authorized user is not risk-free. You should only add a family member or a friend to a credit card that you trust once you be responsible for paying any charges they make to your account. Number 5, closing unused cards. Paying off credit card debt can be a struggle, so it's understandable that some consumers might be tempted to close a credit card after they pay off a large balance to avoid any future temptation to overspend. Yet closing a credit card could have a negative impact on your FICO scores. When you close a credit card, especially an account with a zero balance, it might increase your credit utilization ratio. If your credit utilization ratio climbs due to credit card closure, your FICO scores could decrease in response. If you're worried about overspending, consider whether alternative solutions might work for you instead. For example, you could lock your credit card away in a safe place at home so it's not readily available for impulse purchases. If you need to close an account for another reason, such as avoiding an annual fee on a credit card, you no longer use Try to pay off all your credit card balances first to avoid credit utilization increase. Remember, again, I show you how to get around this in that rsrccpayment.com, rsrccpayment.com. I'll show you how to get around it. Bottom line, a good FICO score may save you thousands of dollars throughout your life. Therefore, learning common credit mistakes to avoid is important to protect your FICO scores both now and in the future. That is Your Credit Matters, brought to you by rsrdebtfree.com, rsrdebtfree.com. When we come back, we're going to chat. We're going to continue our journey here this morning. We are chatting, let's see, auto and homeowners insurance basics that everyone needs to know. We'll chat about that one and what happens if you don't use your credit card. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
79% of all credit reports have errors that should be corrected through factual disputing. You could be saving thousands every year if your report was accurate. CreditSanitizer.com provides a free credit report audit when you furnish a specific $1 credit report. You can use this information to request corrections to your report and potentially save thousands of dollars. Get your free credit audit at CreditSanitizer.com. That's CreditSanitizer.com for a free credit report audit. CreditSanitizer.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio anytime. At 800-306-1990, 800-306-1990. The Borrow Smart segment today being brought to you by rsrdebtfree.com, rsrdebtfree.com. No, we're not pushing the debt free. We just know it's good for you. rsrdebtfree.com. Auto and homeowners insurance basics that everyone needs to know. Having the proper types and amounts of insurance can be a core component of managing your finances. Auto insurance and homeowners insurance are especially important because lenders often require you to purchase coverage if you have an auto loan or a mortgage. Most states also require a minimum amount of auto insurance coverage. Additionally, the right policy can keep an unexpected event such as a collision, storm, or theft from draining your emergency fund or putting you deep in debt. The basic insurance terms to learn. Insurance policies are filled with fine print, but there are some of the most important terms you'll come across when comparing insurance quotes or reviewing your current policies. Premiums. The policy's premium is how much you pay to keep the insurance coverage. You might be able to pay the premium monthly, biannually, or annually. Deductibles. Your deductible is how much you have to pay before your insurance starts covering expenses from a claim. For example, if your deductible is $500 and you file a $2,000 claim, the insurance company may only pay or reimburse you for $1,500. The deductible is generally per claim. You'd have to cover $500 again if you file another claim later on. Coverage limits. Your policy may also have maximum limits for different types of coverage, such as a limit on liability, collision, comprehensive claims, or for auto insurance, and on dwelling and personal property claims for homeowners insurance. Riders. A rider is an add-on that amends your policy to include or exclude specific coverage or events. For instance, A homeowner's policy might have a $2,000 limit for jewelry-related personal property claims. If you have jewelry worth more than $2,000, you might want to pay for a rider to increase the coverage limit. Exclusions. Insurance policies may also exclude certain events or risks, such as flood or earthquake coverage on a standard homeowner's policy. Actual cash value versus replacement cost. You may also want to see if your insurance policy uses the actual cash value, ACV, or replacement cost. With ACV, you'll only receive benefits based on the current value of the item, such as a vehicle or TV, which could have decreased significantly. A replacement cost policy will pay to repair the item or replace it with a comparable item. There are many other terms and fine print items that you may want to learn about. The National Association of Insurance Commissioners has a glossary you can review. You can also ask your insurance agent if you have specific questions about your policy. If you want a great insurance company or agent, give me a call, 800-306-1990. I can put you in touch with them. Find out what affects your insurance rates. In addition to understanding what insurance generally does and doesn't cover, you may want to look for ways to save money on your insurance premiums. A lot of factors can affect your rates, but some of the main ones are your deductibles and limits. You generally pay less for a policy with high deductible and low coverage limits. However, weigh the benefit of saving money today compared to having to pay more if you file a claim. The types of coverage. Adding or removing different types of coverage or benefits, such as roadside assistance with an auto plan or identity theft services with homeowners insurance, can also affect your rates. Your history of filing claims. Insurance companies can purchase reports to see your history of filing insurance claims, similar to how credit reports show your history with credit accounts. Your eligibility and premiums can depend on your previous claims. Discounts. You might qualify for various discounts, such as a discount for having multiple policies with the same company, staying with the company, using automatic payments, paying the bill biannually or annually, not having any recent claims, or having safety systems in your vehicle or home. There may also be factors that are outside of your control, such as where you live, the make or model of your vehicle. But you can get quotes and consider how these could affect your rates before buying a home or vehicle. Regularly shop for insurance to see if you can save money. Although you might receive a discount for sticking with one company for a long time, still a good idea to occasionally shop around and compare home insurance policies and auto insurance policies. Some people make a habit of gathering quotes every 6 months or a year to see if they can save money by changing insurers. Insurance companies might consider different factors or discounts when determining your rates, and you might be able to switch companies and get similar coverage for less money. You can also usually cancel your current policy and change it anytime, and you may get a refund if you paid for the current policy. That is the Borrow Smart segment, brought to you by rsrmoney.com, rsrmoney.com. We have time to get in one more Your Credit Matters, brought to you by rsrdebtfree.com, rsrdebtfree.com. What happens if you don't use your credit card? What happens if you don't use your credit card? I think I've got that one in here. There it is. Not using your credit card can have negative effects, such as your issuer closing your account or accruing fraudulent charges you aren't aware of. Decide carefully if the benefits of not using your card outweigh the consequences. rsrccpayment.com. I just told you that. rsrccpayment.com. That will help you with making sure your credit cards stay active. If you're one of the millions of Americans looking to raise their credit score, you may think not using your credit card will help. After all, many people hurt their credit score by accumulating too much credit card debt. However, you may be surprised to learn of the potential negative consequences that can happen if you don't use your credit card. Here we go. What happens when you don't use your card? Essentially, the worst thing that can happen if you never use a card is that your issuer can close your account and your credit score may take a drop or a dip. This is not unusual. Many credit card companies will close an account if there is not regular purchasing activity. This can hurt your score in a couple of ways: shortening your credit history by decreasing your credit age, increasing your credit utilization rate as your credit decreases, minimizing your credit mix, especially if you don't have many credit cards. Credit card inactivity occurs when you don't make any purchases with a credit card over a certain period of time. The credit card issuer determines this time period. Some may be as short as 6 months, while others may be a year or longer. Before you stop using a credit card, check the terms and conditions to learn what your credit card issuer considers credit card inactivity and their policy for closing inactive accounts. Here are other potential consequences for not using the credit card. Loss of rewards and benefits. Many credit cards include benefits or rewards such as cash back, airplane miles, points, and more. Not only will you lose the ability to earn additional rewards when you stop using your card, but not using your card may cause the rewards you have earned to expire. If you plan on restricting your credit card usage, consider cashing out your rewards to avoid losing any. Accumulation of forgotten balances. If you aren't using regularly, you may not realize your credit card is being charged for an annual subscription or other infrequent charge. These balances will add up and accrue interest, which can balloon your credit card debt and impact your payment history, lowering your credit score. Missed fraudulent transactions. If you aren't regularly making payments with a credit card, you won't be checking your bill, which means it may take longer to catch fraudulent charges. This can impact your score as you accumulate debt you aren't aware of and you miss minimum payments. Decreased credit limit. Your credit card company may reduce your credit limit if your credit card is inactive for a long period. This can lower your credit score by increasing your credit utilization rate, which is not what credit cards want to see. Will I get charged for not using my credit card? Good question. Credit card issuers can no longer charge inactivity fees, sometimes called dormancy fees, when you don't use your card. If you incur an inactivity fee, contact your credit card issuer and the FTC, the Fair Trade Commissioner's Bureau of Consumer Protection. Should you close a card you don't use? Whether to close a card you don't use depends mainly on the facts of your situation. Closing a credit card may hurt your credit more than it can help it, so consider the consequences carefully. Closing a credit card is generally a bad idea because it negatively impacts your credit utilization rate, which is the balance you're carrying divided by your overall availability. It negatively impacts your credit history by lowering your overall credit age, especially if the card is one you've had a significant amount of time. It limits your access to emergency credit options. Closing a credit card may make sense if you're trying to simplify your finances, if you have too many cards for your needs. You're trying to reduce credit risk or struggle with bad credit habits, the issuer charges an annual fee for the card. If you decide to close a card, the process is fairly simple. Start by paying off your balance, redeeming any points or other rewards, and contacting your issuer. Hey, remember, rsrccpayment.com. We're going to show you right there how to deal with this. That is a big situation to save you money. rsrccpayment.com. What are some of the alternatives? Downgrade to a version of the card with no fees. Use your unused credit card to cover automatic renewals or occasional small purchases. Set up automatic payments to avoid missing payments. Again, rsrccpayment.com. We show you all that. Continue monitoring your accounts regularly. Cleanall3.com. Cleanall3.com. Just giving you some ideas right there. That is Your Credit Matters, brought to you by rsrdebtfree.com. rsrdebtfree.com. Let's see. Do we have time to give away a couple of things? No? Okay. Guess we're not going to do that. I got the wave off on that one really quick. As always, we ask, set the first radio preset button to join us every day on Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean for engineering us today. And, of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.